Steve, Brice, thanks a lot for joining us. First of all, I just want to ask you, what do you make of these proposals being put on the table by Nicolas Sarkozy and Angela Merkel?
Well, I suppose there's been quite significant disappointment coming out. I think we felt that markets were a little bit over-optimistic out of what they'd get from this meeting. But, you know, and people were talking about, obviously, the Eurobond issue hopefully coming through, and we think we're a long way from doing that. We'll probably get there eventually, but we probably need another crisis or intensity within the crisis to actually deliver that. So overall, you know, it's still a major risk, a source of risk and uncertainty out there. We see the negative news flow likely to come out of Europe rather than anywhere else in the world these days. So that's what we're all fearful about. If you look outside of that, things are actually starting to get a little better, but Europe is that big cloud overhanging all of financial markets at the moment.
Yeah, not just on this issue, on the debt crisis, but also we saw those really anemic growth figures come out as well. And against this backdrop, according to one analyst, where we've got the politicians sticking their heads in the sand, you know, what next?
Yeah, it does seem like, I mean, I think last week was actually quite an epitome of what they're doing. We're seeing, you know, we saw obviously the concerns over sovereign debt downgrade in France. We saw concerns about the banking sector in France, and you know, we got the indication that the French leaders would meet 5 days later. I think it just shows that they're extremely reactive and probably not very reactive even. And so, you know, I think we're really going to need to see credit default swap spreads widen out significantly, equity markets weaken significantly for them to take this seriously. So, and that's the real fear. And you know, we're not going to see proactive responses. I think that's the key message we've seen over the past week.
Well, against this negative background noise that we have in Europe and the US, I guess it leaves Asia with the only part of the world growing. And does it throw up lots of investment opportunities?
We do prefer Asia to the developed world, so particularly in terms of China, and Japan as well. So those are the two markets that we're really quite bullish on, both obviously from a valuation perspective, but in Japan we're seeing huge upside surprises coming through from the economy and also from the earnings perspective. We're expecting a V-shaped recovery in the economy going forward as well into Q4 and that remaining the case into 2012. So the overall picture, we believe, remains very supportive. We believe QE3, obviously a reflationary aspect, which we're expecting in the first quarter of next year, to also benefit Japan more than most markets. And in terms of China, obviously, you know, we're seeing the growth remaining very strong. Obviously, it's disappointed a little bit in recent times, but still likely to grow around 9% on an annualized basis in Q4 after a weak Q3. We're expecting the People's Bank of China to start easing policy as the next move and before the end of the year, to loosen up on the credit standing or credit conditions through bank lending. So that should be quite positive for China as well. And again, valuations are cheap. So, you know, relative value we feel is out here, and you know, we're fairly optimistic on the global growth outlook over the next 4 to 5 months. Probably less so when we look out to 2012.
Okay, well, I mean, are we talking equities? Is this where we're going to get the bounce, or do you see it elsewhere?
Well, I think, to be honest, we feel like in the States, you know, the technicals are looking positive. We're seeing increased insider buying, so we'll probably get a bounce there as well. We bounced off or failed to break through Fibonacci level overnight, so that wasn't positive. It's not a major one, but obviously enough in the current environment to not be broken. But I think if you're looking on a multi-week basis, we still feel there's upside in terms of equity markets. Over the longer term, we still feel there's a lot of concerns out there. You know, exactly where this growth is going to come from, the downside risks to those growth forecasts, especially when you look into 2012, we do feel is a bit concerning. So, you know, we've certainly become more cautious on the growth outlook over the past month or so, with the data coming out of the States and Europe. But on a relative basis, absolutely. If you're looking versus the G3 markets, growth there is going to be sluggish over the course of the next 5 years. So Asia is where it's at, and valuations are looking increasingly cheap. So you know, outperformance there is expected.
Yeah, quickly, Steve, you're saying in the medium term, of course, that you are perhaps, fearing some slowdown and perhaps not, not the greatest upswing, of course, when it comes to growth. But that surely leaves me to ask you that is the gold story intact for you?
It is. I mean, we've been expecting for a few weeks now, and obviously we're a little bit early, but we're expecting some sort of correction in gold. That's happened. We saw gold rally strongly yesterday. Over the long term, we still feel that gold is a very good investment from a return perspective and also from a portfolio diversification perspective. So we're looking at gold to hit 2100 by 2014. We've seen a little bit of a retracement. That's obviously not that bullish a forecast these days. But it was when we came out with it earlier in the year. So, but yes, we totally believe until people solve their debt problems in the West and in Japan, that gold is going to be a safe haven of choice. Inflation absolutely is required for the indebted economies, and gold is an inflation hedge. So, gold we still believe is very important from an investment perspective.
It's actually astonishingly conservative, your projection there, given what we've seen of late. What about the rest of, what about base metals, of course, with China continuing its growth, albeit even at 9%, rapid?
Yeah, and we've obviously seen industrial metals and energy fall in recent times in line with the equity decline that we saw on growth concerns. We're probably looking out for it in the short term to bottom out and then start rallying. If you look at gold versus oil or versus copper, for instance, oil and copper look undervalued on that basis. Obviously, there's a rationale behind that given the growth. But if we do see that temporary bounce in the US, for instance, and obviously, as you say, China growth over the course of the next a few months and few years, that should be supportive for these over the longer term. So this is probably a buying opportunities for these rather than an indication of substantially lower prices going forward.